Welcome back, everybody. We're diving into the world of Warren Buffett again.
Sounds good.
And this time you've given me some great excerpts from the Warren Buffett Way.
Mm.
And we're going to focus specifically on how he analyzes management before he invests.
Yeah. It's a really fascinating part of his process.
Yeah, before he even looks at the balance sheets or the earnings reports or anything.
Right. He really digs deep into the people behind the numbers.
Okay, so and you've highlighted three qualities that he really looks for.
Yep.
Rationality,
Ah,
candor,
yeah,
and resistance to something he calls the institutional imperative.
exactly.
Now, those sound very philosophical.
Mhm.
I mean, not the typical things you'd expect from, a finance titan like Warren Buffett.
Yeah, you might expect him to be, all about the numbers and the spreadsheets.
Right.
But he really understands that businesses are run by people
Yeah.
and that those people's qualities ultimately determine the long-term success of the business.
That makes sense. So let's break these down, starting with rationality. Now, what does he mean by that in terms of like evaluating a management team?
So Buffett believes that the most crucial skill for any management team is capital allocation.
Okay.
It's about what they do with the company's earnings.
Right. So reinvest in growth, pay dividends, buy back stock.
Exactly. They have a lot of options and a lot of pressures.
Yeah.
But Buffett says that the decision should always be driven by logic, not emotion or trends.
Okay.
He asks the question, will reinvesting these earnings generate a higher return than the cost of capital? If not, it's not rational.
It's got to make sense.
Yeah, it's got to make sense.
So it's not just about spending because you could.
No, not at all. It's about making the smartest choices to maximize returns for the shareholders.
And the book is a great example of this with Coca-Cola, right?
Yes. Coca-Cola started buying back its own shares back in the 1980s. They spent about $1.3 billion
Okay.
to repurchase over 1 billion shares. And a decade later, those shares were worth about $60 billion.
Wow, that is a massive return. But I mean, was that just luck, good timing, or was there something more to it?
Well, that's the thing about Buffett's approach. He looks for companies that are already strong,
Okay.
and then he tries to buy them when their stock is undervalued.
Ah, okay.
So in the case of Coca-Cola, the buyback happened during a period when the stock was arguably undervalued.
So they were getting a bargain, essentially.
They were essentially buying $1 for 50 cents.
Wow.
That's smart capital allocation.
Yeah, it makes you think about how many companies miss out on those opportunities because they're too busy chasing, the next big thing.
Absolutely.
The book also mentions American Express making a not-so-smart move.
Yeah, the acquisition of Shearson Lehman.
Oh, right.
It became kind of a textbook example of poor capital allocation.
What happened there?
They strayed from their core business, and it really hurt their performance.
So even these really established companies can make mistakes if they don't make rational decisions.
Absolutely.
Now, what's interesting is that American Express did eventually turn things around, right?
They did a change in leadership, brought a renewed focus on their core business,
Oh,
and they started buying back their own stock.
okay.
This move was really profitable, especially for long-term investors like Buffett.
So it's a good reminder that good management can really make or break a company, even one as big as American Express.
Yeah, absolutely.
Okay, so we talked about rationality now. Let's move on to candor.
Okay.
Buffett also wants managers who are honest with shareholders, even when things aren't going well.
Transparency is crucial for Buffett.
Okay.
He contrasts Berkshire Hathaway's approach with the overly optimistic spin that you see in a lot of corporate annual reports.
So you mean he actually admits when things have gone wrong?
Exactly.
That's pretty rare, isn't it?
Yeah.
Most CEOs just want to talk about the successes.
Yeah, they just want to, highlight the wins.
Right.
But Buffett's annual letters are famous for their frankness. He'll openly discuss Berkshire's challenges, setbacks, with deals like the General remerger, even his own investment missteps.
He admits when he makes mistakes.
He does.
Yeah.
He believes in learning from those mistakes and being upfront with the people who have entrusted him with your money.
Yeah, I get that. It's like when you're dealing with a doctor or a financial advisor, you want someone who's going to level with you, not sugarcoat everything.
Right. You want that honesty and trust.
Right. But is that level of candor even realistic in the corporate world? I mean, don't they need some level of spin to keep investors confident?
That's a good point. There's definitely a balance between transparency and, not revealing too much.
Right.
Especially in a competitive market.
Yeah.
But ultimately, Buffett argues that honesty builds trust.
Okay.
and that trust is essential for long-term success.
And it makes me think about my own experiences. I'd much rather work with someone who's willing to own up to their mistakes than someone who pretends they're perfect.
Absolutely.
Okay, so we've got rationality and candor. What about this institutional imperative? It sounds a little ominous.
It can be.
Yeah.
Think of it as they tied commissions to the quality of those loans.
Wow, that's really going against the grain.
It was a bold move.
Yeah. Did it pay off?
It absolutely did.
Yeah.
While other companies were struggling with bad loans and high delinquency rates, Clayton Homes maintained a much lower rate, even during economic downturns.
Wow.
Their independent thinking and their resistance to that herd mentality proved really valuable.
That's a powerful lesson for all of us, not just in investing, but in life.
Exactly.
Sometimes the smartest move is to go against the grain,
Right.
even when it feels uncomfortable.
Yeah, sometimes the nail that sticks out is the strongest one.
I like that. Okay, so we've covered rationality, candor, and the institutional imperative.
Uh-huh.
But this is just the tip of the iceberg when it comes to Buffett's approach to evaluating management, right?
Oh, yeah. There's so much more to unpack.
Okay, so I think we need to dive in a little deeper.
Sounds good. Let's do it. The book also goes into Buffett's ethical stance
Yeah.
when he's evaluating management.
Okay.
He's really critical of things like CEO greed, excessive stock options, and what he sees as negligence from boards of directors.
It's interesting how he ties ethics to investing. It's
Yeah.
not just about making money.
Right.
It's about doing it the right way.
He's advocating for a different approach to business.
Yeah.
One that prioritizes long-term value and shareholder interests
Okay.
over short-term gains and executive enrichment.
And that long-term perspective seems to be a recurring theme with him.
Yeah, absolutely.
The book specifically mentions his views on stock options.
Uh-huh.
He's not a fan.
You know, he's been very vocal about the need to expense stock options
Okay.
to reflect their true cost to the company.
Right, because for a long time, a lot of companies didn't account for them as an expense.
Right, and that distorted their earnings picture.
So I'm not an accountant, but I can see how that would create a misleading picture of a company's financial health.
Absolutely.
Is that what he means by transparency?
That's a big part of it. He believes that shareholders deserve a clear and accurate understanding of a company's performance, without any accounting gimmicks or attempts to hide the true cost of doing business.
So it's not just about ethical behavior.
Right.
It's about making sure the numbers reflect reality.
Exactly.
Okay, all of this is great in theory, but how can I, as an individual investor, actually use this information? It's not like I have Warren Buffett's resources or access.
Right. You don't have his team of analysts,
Yeah.
but you have more tools at your disposal than you might realize.
Okay.
The goal is not to become a Buffett clone.
Right.
It's about developing your own judgment,
Okay.
making informed decisions.
Okay, so where do I even begin?
Well, you can start with the company's annual reports.
Okay.
Buffett recommends going back several years
Okay.
and analyzing what management said about their strategy
Okay.
compared to the actual results.
Okay. So were they able to achieve what they set out to do?
Exactly. Did they adapt to changing conditions?
That's a great idea.
Oh.
I usually just focus on the latest earnings report. But looking at the long-term trends could reveal a lot about management's track record.
Absolutely.
What else should I be looking for?
You could also compare the company you're interested in
Okay.
to similar companies in the same industry.
Okay.
Are they outperforming or underperforming their peers?
So it's about context.
Yeah.
Is the company genuinely well run, or are they just riding a wave?
Exactly. That's a great way to put it.
The book also mentions some red flags that Buffett watches out for.
Oh, yeah.
What are those?
One of the big ones is weak accounting practices,
Okay.
especially companies that avoid expensing stock options.
Okay.
That's a sign that management might not be as transparent as you'd like.
Makes sense. If they're playing games with the numbers, there's probably a reason.
Right.
Any other warning signs?
Yeah. Be wary of companies that are constantly trumpeting earnings projections
Okay.
and future growth expectations,
Okay.
because no one can predict the future with certainty.
Right.
So this can sometimes be a way to distract from present weaknesses.
So it's like they're trying to sell you a dream instead of focusing on concrete results.
That's a good way to put it.
Okay.
And finally, unintelligible footnotes in financial statements are another red flag.
Okay.
If you can't understand what they're saying, it could be a deliberate attempt to obfuscate information.
So it's about being a bit of a detective.
Yep.
Looking for clues that reveal the true character of the management team.
Exactly.
This sounds like a lot of work.
It can be, but remember, you're investing your hard-earned money.
Yeah.
It's worth taking the time to understand who's managing it,
Right.
and whether they're truly acting in your best interests.
That's a good point. You're essentially becoming a partner in the business.
Right.
So you want to make sure your partners are trustworthy and competent.
Absolutely.
This has been incredibly insightful.
Yeah.
I feel like I have a much better grasp of how to evaluate management,
Good.
but it's a lot to take in.
It is. Don't expect to become a stock-picking expert overnight.
Right.
It's a journey of learning and developing your own judgment. The more you practice these principles, the more confident you'll become.
So to wrap this all up,
Okay.
Buffett's approach to evaluating management goes far beyond just crunching numbers.
Yeah.
It's about understanding the people at the helm, their decision-making process, their values, and their ability to resist potentially disastrous industry trends.
Right. It's about recognizing that a company's management is the driving force behind its long-term success.
Okay.
They're the ones who will ultimately determine whether a company thrives or struggles.
And while we may not have Warren Buffett's level of access or expertise,
Right.
we can still learn from his approach and apply those principles to our own investment decisions.
Absolutely. It's about empowering you to become a more informed and discerning investor.
Okay.
It's about developing your own judgment and making choices that align with your investment goals.
It's really, like you said, it's like learning a new language.
Yeah.
It takes time and practice, but I'm starting to get it.
Mm-hmm.
As we wrap up this deep dive, maybe you could give our listeners a little challenge here.
Okay.
Let's say I'm thinking about a company I'm interested in, maybe one that I might want to invest in.
Mm-hmm.
How would I evaluate their management based on what we've learned today?
That's a great question. So start by thinking about those 3 key traits that we talked about.
Okay. Rationality, candor, the institutional imperative.
Right. Look for evidence of those qualities in the company's actions, their communications, their overall approach to business.
So I really need to dig deeper than just, the surface level.
Yeah. Don't just read the latest press release.
Okay.
Go back and look at their track record.
Okay.
See if their actions align with their words.
Makes sense.
Review their annual reports. But don't just skim them.
Okay.
Analyze their capital allocation decisions over time.
Okay.
Have they been consistently making smart choices?
Okay.
Are they investing in growth that makes sense, or are they just chasing fads?
Right. And like you said, don't be afraid to compare them to their competitors.
Exactly.
Are they leading the pack or are they lagging behind?
It's all about context.
Yeah. And what about candor? How do they communicate with their shareholders?
Right. Are they transparent about challenges, or do they only highlight the wins?
Okay.
Do their pronouncements match reality?
It's easy to get swept up in the hype, but I'm starting to see how important it is to look beyond the PR spin.
Absolutely.
And then, of course, we can't forget about the institutional imperative.
Yeah. Are they making decisions based on sound reasoning, or are they just following the crowd?
Okay.
Even when it might be risky.
Mm-hmm.
Are they willing to buck trends and forge their own path, like Clayton Holmes did?
Right.
That's a really important thing to consider.
This has been such an eye-opening deep dive.
I'm glad to hear that.
I feel like I have a whole new toolkit for evaluating companies.
That's great.
It's empowering to know that I don't have to be a Wall Street guru to make informed investment decisions.
Exactly. It's about asking the right questions, doing your research, and trusting your own judgment.
You are in control of your investments.
That's right.
This deep dive has just equipped you with the knowledge and the confidence to make smarter choices.
That's what we're here for.
Awesome. Well, thank you so much for guiding us through this fascinating exploration of Warren Buffett's wisdom.
It's been my pleasure.
I've learned so much, and to everyone listening, I hope this deep dive has inspired you to think differently about investing.
E2?
And giving you the tools to start evaluating companies like a pro. Happy investing, everybody.